Today is February 9th, 2026.
Did you catch the Super Bowl this year? It wasn't just about football. It was the AI Super Bowl. Anthropic dropped a cool $14 million onto ads. Basically just to troll OpenAI. It felt like a cultural moment, right? A sign that AI has finally gone mainstream. But what if it was a sign of something else entirely? What you might see as a grand arrival, I see as a bubble getting ready to burst. Think about it. When companies that aren't even profitable start spending $7 million a pop on ads, they're not selling you a product. They're selling you a story, a growth story. This feels eerily familiar. Back in the year 2000, during the dot-com Super Bowl, 14 different internet companies bought lavish ads. Within 2 years, most of them were gone. But wait, aren't these AI companies making hundreds of millions in revenue? Sure, but revenue isn't profit. OpenAI is reportedly operating with massive debt to its investors just to cover the cost of chips. They're selling a future they haven't built yet, and the market is buying it hook, line and sinker. The stock market is hitting all-time highs. It feels like the party will never end. But that's because we've already priced in the next 10 years of AI success into the last 2. We're at a point where even fantastic news can't move the needle. When Microsoft recently smashed its earnings report, the stock actually fell. That's a classic sign of a market top when perfection is already expected. There's no room for error, only disappointment. Some people say the Fed will just lower rates and save the day. But that might not happen this time. We could see a major shift in policy that focuses on shrinking the Fed's massive balance sheet, which would actually push long-term interest rates higher. At those higher rates, the crazy valuations for tech stocks just don't make sense anymore. So, what were those flashy Super Bowl ads really? A signal flare. We're currently sitting on a mountain of over $1 trillion in margin debt, which is up a staggering 36% in just 1 year. Everyone who could possibly buy into the AI hype is already all in. When the reality of AI fails to meet these impossible expectations, that debt will trigger a wave of forced selling. Those ads weren't just a bit of fun, they might have been a warning. They are a classic social signal of market excess. Let's explore 10 other historical signals that showed when markets were convinced they could never go down.
Number 1. Valuations shift from cash flow to future narratives.
Let me start with something that sounds incredibly simple. For most of investing history, the core question was kind of boring. How much cash does this company actually make? Not promises, not vision, not a slick slide deck, real tangible cash. But now, listen to how people talk about AI stocks today. You'll hear phrases like total addressable market or this will change civilization. Here's the thing. In 2025, Nvidia was trading at over 35 times its forward earnings, while its free cash flow yield dropped below 3 at its peak. Compare that to the year 2000. Cisco was the Nvidia of its time. At its peak, Cisco hit a massive market cap, trading at over 120 times earnings. People didn't care about cash flow then either. They cared that the internet will change everything. And it did, but it didn't save the stock price. Cisco fell 80 and took 20 years to recover. So, when valuations detach from cash and start floating on stories about the future, it doesn't mean the story is wrong. It just means the price has moved way faster than reality. And historically, that gap always closes. Number 2, this time is different, the myth of endless growth.
Have you ever heard the phrase, "This time is different"? It's a line that pops up in every financial bubble, and it's a dangerous one. Let's take a quick trip through history. Back in the 1920s, the new tech was electricity. Productivity soared, and economists claimed business cycles were a thing of the past. Then came the crash. In the 50s and 60s, it was cars and highways. General Motors was seen as a company that would grow forever. We know how that story ended. Fast forward to the late 90s, with the dot-com boom. The magic words were productivity revolution. The Nasdaq doubled, and then it crashed. Today, the story sounds familiar, but the technology is AI. We hear the same promises. Endless growth, no more downturns. Maybe they're right, but history teaches us a lesson. The problem isn't the innovation itself. It's when we price that innovation for perfection, assuming growth will never stop. Because the moment we declare the cycle is dead, is often the exact moment it comes roaring back to life. Number 3, market leadership becomes dangerously concentrated.
Here is something people rarely worry about during a bull market. How many stocks are actually carrying it? In 1929, it was giants like AT&T and General Electric. At the peak, just 10 stocks made up over 40 of the market. In the early 70s, it was the Nifty 50 Coca-Cola, IBM, McDonald's. They were called one-decision stocks. You just buy them and never sell. Then the 1973 crash happened, and some of them fell 80. Fast forward to 1999, the Nasdaq's top 5 stocks, like Microsoft and Cisco, made up nearly 30 of the index. We all know how that ended. Now look at today. The Magnificent Seven: Apple, Microsoft, Nvidia. At one point, they accounted for over 30 of the S&P 500. The rest of the market barely moved. When leadership gets this tight, the market becomes fragile. Not because these companies are bad, but because too much hope is resting onto few shoulders. History shows that's never a stable position. 4. Retail confidence rises, risk awareness quietly disappears.
You know what's funny about markets? People don't panic at the top. They get relaxed. Think back to 1999. The internet was booming. Day trading was the new craze, and the Nasdaq shot up 85 in just 1 year. Most everyday investors thought 20 returns were the new normal. Margin debt was at a record high. Nobody was asking, what could go wrong? They were asking, what am I missing out on? It happened again in 2006. Remember all those home flipping shows and no money down mortgages? Consumer optimism was through the roof, right before the housing market peaked. Now, look at today. Retail trading is massive. Options trading is near all-time highs. Confidence is sky high, and fear is low. This isn't because the risks have disappeared. It's because the market has trained people to ignore them. This isn't a prediction for a crash, but it's a classic warning sign that market psychology is getting stretched thin.
Number 5. Volatility looks calm, but risk is being compressed, not gone.
Let me ask you a question. Does the market actually feel dangerous right now? For most people, the answer is probably no. The VIX, the so-called fear index, has been hovering around 12 to 15 for much of this year. Even with recent dips, it's still relatively low. It feels calm, right? But this calm is deceptive. Think back to 2006 and early 2007. The VIX was chilling at similar levels for months. Meanwhile, the housing market was quietly cracking. But stocks barely reacted. People genuinely thought they had solved volatility. Today, the tools are different, but the effect is the same. We have massive passive investing, complex volatility selling strategies, and the explosion of zero-day options. On some days, nearly half of all S&P 500 options expire the same day. This creates an illusion of stability, as any dip gets instantly bought up. But low volatility doesn't mean low risk. It often means risk is being compressed, like pressure building in a sealed tank. It looks fine on the surface, until one day it isn't. Remember, volatility doesn't gradually rise. It explodes. Don't mistake a quiet market for a safe one.
Number 6. Passive and algorithmic dominance breaks price discovery.
Let's talk about who is really moving prices in the stock market today, because it's not who you might think. Right now, in the U.S. equity market, a massive 55 to 60% of daily trading is done by algorithms. On top of that, about half of all stock ownership is in passive funds like index ETFs. Just think about that change. Back in 2000, passive investing was under 15%. Now, here's the issue. Passive money doesn't make decisions. It doesn't analyze if a stock is a good buy. It just buys when money flows in and sells when money flows out. Algorithms are similar. They follow momentum and volatility, not company fundamentals. So when prices fall, it creates a dangerous loop. Outflows trigger more selling, which creates volatility, which triggers even more algorithmic selling. This is why modern market drops feel like hitting an air pocket. Prices don't just slide anymore, they plummet.
Number 7. Leading stocks crumble internally while index holds up. Ever get that feeling that something's off in the market? Even when the headlines look good. We're seeing the S&P 500 and Nasdaq barely moving, maybe down just 1% or 2%. It seems fine, right? But let's look closer at some of the big leading stocks. They're showing signs of trouble internally, slowing orders, supply chain problems, and guidance cuts. Some have even seen a significant uptick in insider selling. This isn't just a hunch. History gives us a warning. Think back to the dot-com bubble in 2000. Giants like Cisco and Intel dropped 30 to 50% before the Nasdaq index even reacted. The danger is focusing only on the index, which can give you a false sense of security. The market leaders often crumble from within first. Once they lose their footing, the whole index can follow them down. So, it's crucial to pay attention to the internal health of these key companies, not just the headline number. Number 8. Valuation models start adjusting reality to fit prices.
Have you ever noticed this? A stock's price shoots up 40 or 50%, and suddenly, the valuation models start to change. Not the price, but the assumptions behind it.
Yeah. You start hearing analysts say things like, "We're extending the forecast period," or "Let's just normalize the margins a little bit higher."
Exactly, take the current AI boom. Analysts who once modeled 5 years of high growth are now pushing it to 10, sometimes even 15 years. That alone can double a company's valuation.
Then there's the discount rate, which quietly drops from 9% to 7%. A 2-point drop like that can make a company's value jump 30% overnight.
Well, we've seen this before. In 1999, analysts valued companies based on eyeballs and clicks instead of earnings.
Yeah, Yahoo was trading at over 100x forward sales, and people said, traditional valuation doesn't apply anymore. Same thing in the Nifty 50 era. Stocks at 50 to 60x earnings, justified by saying growth was guaranteed.
The pattern is always the same. The price moves first, and reality gets adjusted afterward. This doesn't mean the price is wrong, but it's a clear sign that risk is rising. Number 9. The illusion that retail investors are policy protected. Let me ask you something. How many times since 2020 have we seen the market take a dive, only to bounce back even harder? Too many to count. And that's the core of the problem. Remember March 2020? The S&P 500 plummeted 34 in just 33 days, the fastest crash ever. Then, like clockwork, the Fed stepped in. Quantitative easing went from nothing to $120 billion a month. Interest rates hit zero. Stimulus checks and loans went out. Retail investors learned an emotional lesson that year. If prices fall, someone will come to the rescue. Every dip since has reinforced this belief. The 2021 inflation scare. The 2022 tightening panic. The 2023 banking stress. Each time a safety net appeared. Now, investors don't ask if an asset is expensive. They ask how bad things need to get before the Fed intervenes. This turns risk into a one-way bet. But this policy protection only works until it suddenly doesn't. Number 10. Real technology. Financialization pulled forward.
Let me start with a confession. The most dangerous financial bubbles aren't the fake ones. They're the ones built on real, game-changing breakthroughs. The technology absolutely works. And that's precisely why so many people get tripped up. Let's rewind to the 1800s and talk about railroads. Between 1830 and 1870, the U.S. rail network went from practically nothing to over 70,000 miles of track. This was incredible real progress. Travel times collapsed, and trade exploded across the country. But the money got their way too fast. By the 1870s, railroad stocks and bonds made up about 40% of all U.S. capital markets. That's too much capital too early. The result? The Panic of 1873 and a depression that lasted for years. We see the same story play out in the 1920s with electricity. Factories were electrifying, productivity soared, and household appliances started appearing everywhere. Between 1919 and 1929, industrial output jumped by nearly 50. It was a genuine revolution. But stock prices ran way ahead of actual usage. Utility and electrical companies were trading at 30 to 40 times their earnings. In a world where GDP growth was maybe 3 or 4%, then 1929 hit. The technology stayed, but the crazy valuations didn't. Now, fast forward to the 1990s and the internet. Even by 1999, less than half of U.S. households had internet access. And online shopping, it was a tiny, single-digit percentage of total retail sales. Yet, NASDAQ stocks were trading at average price-to-earnings ratios above 60. Some companies had no revenue at all. Petscom didn't fail because the internet was a fake idea. It failed because capitalized dreams arrived a decade too early. So let's look at today. Artificial intelligence. The tech is real. There's no debate about it. GPT, Copilot, Claude, these tools work right now and are already changing things. But look at the numbers. NVIDIA's market cap went from around $300 billion to over $2 trillion in about 18 months. Big Tech's spending on data centers jumped from roughly $120 billion in 2021 to a projected $500 billion by 2026. Here's the core tension. Society adopts new technology gradually, step by step, but capital markets price it in instantly, all at once. And that gap, the one between real, steady progress and lightning-fast financial speed, is exactly where bubbles are born. The technology almost always survives. The timeline for its financial success often doesn't. Thanks for watching. What do you think about the current AI boom? Let me know in the comments. And don't forget to subscribe for more insights.
AI-assisted analysis and illustrative visuals. Educational content only, not investment advice.